Hey guys, it's Chad Larson with MLD Wealth Management Group with Canaccord Genuity. As we continue to develop content through this pandemic of coronavirus, I'm happy to be joined here by Mike MacBain. Um, Mike's going to talk to us about a myriad of topics, but as we've been kind of discussing with the credit markets and this coronavirus and what's happened, we knew what happened. The market crashed, the market has rallied, and now we're really in the last week been discussing a lot about what next. A lot of that is tea leaf reading comparative to previous crashes. It's different this time, famous last words almost in every marketplace. But as we look for opportunities in the marketplace, never have we seen such opportunities that have presented themselves on a risk-adjusted basis, even on an absolute basis, that we see in credit markets. For many of you who haven't met Mike MacBain has over 30 years of experience in the financial services industries, previous roles within investment dealers. He was the managing director and head of global debt markets with RBC Capital Markets and formerly the president of TD Securities. Mike is well accoladed and has a CV that this video would be probably long if we continue to read it. So now that I've pandered to Mike's ego, I really want to thank you for being here. And I know a lot of this we're gonna talk about might be some of it's jargon, and that's the industry that we live in. And I don't understand what my electrician says for most times, but he gets the job done. So if there are questions at the end of this, feel free to reach out to me, and I'll help kind of decipher from this. So Mike, again, thanks for being here and sharing some of your time and expertise with myself and my clients. What's going on at East Coast, and what are you seeing in credit markets?
First of all, I appreciate you having me on, Chad. It's been busy. It's been a very strange sort of time for not just in the markets, but just personally, professionally, all the way around. But the credit markets, in my mind, especially investment grade credit, has never really been. There's never really been a market like this before. If you look at the speed at which credit spreads widened through March, that's never happened before. We got to credit spread or credit yield levels that were wider than the financial crisis in a period of about 8 days. And I think in this slide deck, there's a chart here to show those sort of credit spread levels. Can I get you to flip that slide?
Try. Here we go.
Attaboy. So if you look at this chart here, it doesn't actually show spread levels getting as wide as they got during the crisis. But that's really because the market's closed. We were seeing packages of bonds trading in this sort of square window that I've highlighted here. That's above where the bonds are actually officially posted to be trading. And the reason that those prices didn't actually filter through into the index and into actual transaction data is because there were transactions that took place in packages. So you could buy 50 companies in a package, all at a yield of 9%. One year bonds trading at 9%. Of sort of single A and double A banks at the height of how crazy things were.
So is that just a race on liquidity or just complete pandemonium?
There was no bid, no offer, nobody was working, and you had daily liquidity mutual funds that were getting redemptions, and they had to meet those redemptions, and they had to sell at any price. So that's basically what was happening. The only transactions that were taking place were these block trades where people were putting sort of packages of 50 sort of well-known names together, all bonds under sort of 9 months, and they were trading anywhere between 6% and 9% when that was happening. So if you compare that to an index, level, you were well north of where we were trading during the crisis. And so that has created, pretty obvious opportunities in that exact moment. That only took place over about 2 days. And the snapback, as you said, has been pretty sharp here, because the official posted stats here, credit spreads went from sort of 275, 280 in investment grade index down to sort of 240, and by the end of the month, and then in April down into the sort of high 100, like 198, 199, which is kind of where we sit today, interestingly. And so that sort of, immediately ratcheted back a lot of immediate P&L, and now we're sort of sitting here where, we'll get into it a little bit later in the deck, but where credit curves are starting to normalize. The whole cause for this crisis was a liquidity crisis. That lack of liquidity was generated because banks needed to fund about $75 billion worth of committed lines of credit, when investment grade borrowers immediately drew down on their lines of credit en masse. And that caused a bank funding crisis. And so the sort of remedy for that was the central banks coming in to solve the bank funding crisis. And now what you're experiencing, or what we're seeing, is the terming out of all that debt from off the bank's balance sheets into the credit markets. And so now we're seeing quite a meaningful normalization of credit curves. And what I would expect to continue, a steepening of those credit curves. So, if you want to flip to the next couple slides, we'll just go over these really quickly, and really it's talking about interest rates. Interest rates have been on a downward track for forever, it seems. And this is just Canadian interest rates. So Canadian interest rate, 10-year bond yields are the lowest they've ever been. This next slide here just gives you more perspective and takes you back, 150-ish years in U.S. and U.S. 10-year yields, and you can see again we're at all-time lows in U.S. interest rates. And I don't really put these up here to predict what's going to happen to interest rates next, but just to say that we're in a period of unsustainable interest rates. They're not going to be at zero forever. I'm not predicting they're going to be much higher than where they are now in the very near term, but you can be sure that we're not going to be at the lowest level of interest rates, for 30 years.
Your bucket that you're trading both predominantly in Canada, cross-border names, some US. What, with the Fed, aside from providing the liquidity from central banks, can you talk a little bit about the bond buying that's going on? And effectively, it's kind of like everyone's being bought right now. And is that positive?
Yeah. So the technicals in the credit markets right now are very positive. You alluded at the begin your intro into the conversation that it's anybody's guess whether or not the economy pulls through this in a meaningful way, and what that means for the equity markets. Certainly the equity markets are predicting a pretty positive outcome, I would say, where it stands right now. But the technicals of the credit market are such that, with the additional buying buying of investment grade credit from, the central bank or Bank of Canada, as well as the Fed and the ECB, the technical support for liquidity and, quite frankly, credit appetite is pretty massive in both markets. And everybody kind of sneers at the Bank of Canada's $10 billion that they're gonna put to work in the Canadian investment grade credit market, but it's actually quite a significant amount of bonds when you pair out all of the eligible criteria and the names that they're willing that they can buy, because insurance companies and banks are off the table immediately. And so you're gonna see purchases in the segment of the market that's been most disrupted, in my opinion, and that's going to be most disrupted in the investment grade space, in the what's deemed to be the not default space. And so I think that's going to be a meaningful benefit to the market. We've had a pause here in terms of credit spread narrowing, mainly because the supply of new issues has been, formidable. Like we've had, in the U.S., they've probably had 9 months of new issuance take place in the past 6-8 weeks, and in Canada, they've probably had 7 or 8 months in the past 6 to 8 weeks. So
was the stat? I think I read something almost $1 trillion of new issuance in the bond market.
Basically since the third week or the last week of March, basically. Wow. Yeah, and to put that in perspective, that's a full year of issuance, $1 trillion in the U.S. So, it's all, a large chunk of this is front loaded, right? This is not, people don't need the companies don't need these massive amounts of debt. They are obtaining liquidity to make sure that they can survive the next 12 to 18 months. But, really that's just front loading liquidity that they're going to need for later. And most companies are really just pre-financing 12 to 18 months of rollovers. And so it's a supply hurdle to overcome right now, which is causing credit spreads to kind of pause and stay at these wide levels that they're at. But we get through the end of the summer and all of a sudden, this debt's already been pre-funded, and, there's no more, it's not that there's no more debt, but because we live in a world where that will never be the case. But
yeah, I think people need to understand that, understandably, I think most of our viewers and clients would understand that bond market is significantly larger than the equity markets, and everyone wonders, equity is very simple. You need a buyer to buy, a seller and a buyer to meet in the marketplace. And where do new buyers constantly come that want to refresh and take on a story? The bond market seems to naturally have that cycle. As your maturities come due and you have a mandate, you have to buy something. Is that as simple as it is? The rotation, if there's not new issuance, that as your maturities roll off and you need to be a buyer.
Well, yeah. I mean, people have the reality is that you have a certain amount of money to allocate, and every month that goes by, portfolios roll over and mature. So it also means that the prices go back to par. So when credit spreads widen, they can only widen for a period of time, because it's like an elastic band. If that company's not defaulting, it's going to pay off at par, and credit spread's going to mature at zero. So, right. So both of those things are true.
Okay, so time and duration, obviously, it helps that credit spread tighten.
Totally. Yeah. Okay. So that just in terms of interest rates, you're now looking in a scenario. Flip the next slide, which kind of follows on from this, is that we've never been in a world where so much of the yield of an investment grade bond has come from the credit portion, and so little of the yield of investment grade bonds come from the interest rate portion. And so, here is just a schematic of what the yield was of just a standard kind of single A, triple B, high rated investment grade corporate bond in pre-COVID, was a little over 2.33%. If you break up that 233 basis points that bond was yielding, Feb 21, it was roughly, give or take 50-50 of that yield was coming from the credit piece and coming from the rate piece. GOC stands for Government of Canada, for those speaking that we're talking about jargon earlier on. So that's just the Government of Canada bond would be the yield of a Government of Canada bond, which is effectively the interest rate yield in this illustration. And so, you can see that the actual yield of the bond hasn't changed much overall through COVID, but the dynamics or the characteristics of that yield have changed meaningfully. So the credit piece has widened a ton, and the rate piece has declined a ton. And so now you're sitting with effectively the same yield, but all that yield, or 80% of that yield, is coming from the credit spread piece. So when you think about, risk-adjusted return, or where you're getting your relative value opportunity, you've never been getting a larger relative value opportunity than you're getting today in credit, and you're never getting a lower one than you've ever been getting before in rates. And so again, I don't expect rates to move meaningfully off 50 basis points in the foreseeable future, but 50 basis points isn't an interesting yield. It's not interesting in terms of portfolio protection that you used to get from owning a rate product. And God forbid we get into an environment at some point, which I'm sure we will, where rates are going the other direction, then it's a capital destroyer in that environment.
And how do you guys solve for that? I think that's a bit of a tee-up question, but within your process.
Yeah. So in our process, we're rate neutral. So we effectively buy that corporate bond, the blue box. So I'm long that position, and then I sell short the Government of Canada bond in the illustration beside it. So I'm effectively long the entire security, short the government piece of it, and that leaves me as a remaining exposure just to the green box. So that's how we eliminate the interest rate exposure, and that creates the exposure that we want, which is the highest risk-adjusted returning one. It's the exposure that's not correlated to interest rates in an environment where most asset classes are correlated to interest rates, and leaves us with effectively a separate asset class in terms of how it behaves.
Right. And so the portfolio still remains cheap on a relative basis to what you would expect from, I don't know, I struggle with people's, I get comments all the time and they ask me how companies are doing. And I know we're going to talk to a slide about Ford in a second. A client called me the other day and he's like, I wonder how how this auto dealership group is doing. And my response was, well, they're not selling any cars today. And this was going back a month. But we do have an ongoing business and capital structure that will support that. So as we kind of get into the last kind of 3 to 4 or 5 minutes of this, we have an opportunity still as credit spreads remain wide historically. What do you see kind of good things going forward with respect to kind of the balance of the year?
Well, I think that if you look at this chart here in terms of credit spreads, you can see where credit spreads were pre-COVID. That was sort of in around the tight area of terms of where credit spreads have been. You can see where we are now. That's wider. Even today, that's our April 30th numbers. That's wider than credit spreads have been in the European banking crisis, wider than they were at the wides of the oil crisis in October of 2000, or sort of late 2015, early 2016.
Mm-hmm.
So you're getting paid very adequately for your investment grade credit exposure today. The yields in our fund, our East Coast Strategic Credit Fund, are north of 10%, around about 12% right now. So 12% from an investment grade credit fund. Just to put that into perspective, the only time we've been higher than that is now in the last 5 or 6 weeks. And we'd never been higher than 10% in our 10 years in history. And, as we came into this, the yield of the fund was about 470. So we've generally have a yield of somewhere between kind of 5% and 7%. And so a 12% number is just a ginormous number in terms of the fund.
So there's meat on the bone. What does the current portfolio sit like today from a diversification standpoint and ratings?
So there's a slide. If you flip further on, I'm not sure where it is, but there's a slide. There you go. Perfect. You just passed it. So here's the breakdown in terms of the fund. So banks are 50%, telcos 9%, autos just under 8%, and REITs just under 7.5%. So, overall as a portfolio, average ratings single A low. The biggest sort of circuit breaker or protection in our portfolio, however, is the short maturity date or average life of the portfolio. So the average life of the portfolio is about 21 months. I got about just under 50% of the portfolio that is rated triple B or lower. Only 4% below triple B, so double B. About half.
Is that a function of rate, like ratings downgrade, or just a unique
That's really a function of Ford, which we may hopefully get time to talk about in a second.
Yeah,
but
let's jump to Ford. I think as I'm running through it, I think we spent a lot of time getting our slide deck prepared for the call, and so we're going to run out of time in about 6 minutes or so. So let's talk Ford.
Okay, so Ford's on the next slide. So Ford is a company that we've owned. Most of there's a maturity profile on these bonds. So 56% of the bonds that we own mature in September. Another sort of 10-ish% mature in December. They all mature inside 2 years. But you can see the credit spread on the left. The Ford bonds went from a spread of 110 to a spread of 1150, and they're now in the sort of 600-700 basis point range. This company is, autos is obviously one of the companies that's impacted indirectly by COVID. I mean, it's nowhere near as badly impacted as oil and gas and travel and leisure and entertainment, but indirectly it's impacted. Having said that, car sales coming out in the last couple weeks have been shockingly good. I guess nobody wants to get on a subway anymore. Maybe that's it. But Ford as a company, they did get downgraded. They were downgraded towards the end of March. They are included in the Fed's buyback program. So the Fed, determined that the rating of the bonds that they were going to buy was pre the announcement of Ford's downgrade. So they are buying Ford bonds. Ford has about $40 billion of cash, about $10 billion of lines of credit they can draw on. They did an issue in the U.S., about an $8 billion issue at the auto company level. So our exposure is all at Ford Motor Credit, which is a structurally better credit. I have a real hard time thinking this company is going to get into any trouble inside the window that we have to be concerned about. So we're holding on to these positions. They're paying 7%. It's a great exposure to get 7% for. That's a solid high yield sort of return from a company that has just been downgraded, has tons of cash. And really, my exposure is all inside 1 year.
That's great. And like on to the next, we have REITs. I think everyone's wants to just react because a couple missed rent payments, or there definitely seems to be camps that thinks everyone's going to work from home. But we've been seeing a ton of issuance, new issues and bolstering the balance sheets of real estate companies and not real estate. Is this be the same across your portfolio, similar to that of Ford? Is that you have an outright position in believing that credit will remain intact through a short period of duration?
Yeah, I think that's our general feeling. So if I think about REITs, again, the bulk of our REIT exposure is rolls off inside 2 years. A good portion of our REIT exposure is grocery anchored. So Loblaws REIT, Sobeys REIT. Those companies have had no problems whatsoever, and so I'm not really concerned about those at all. Those companies that I have some exposure in, like RioCan, which is basically shopping center REIT, which I think is probably the worst impacted, or should be the worst impacted by this. That exposure, the bulk of it actually matures June 1st, so in a few days. And then I've got a little bit, tiny bit more exposure there that runs out to, I think it's either November or January of next year. So November of this year, January next year. So all these companies are carrying liquidity profiles in the kind of 15 to 25% range. And with that kind of liquidity, I think that they can easily meet their debt refinancings for the next kind of 18 months.
Right.
So we feel pretty comfortable about our exposure and don't think that we need to sell it other than opportunistically as the bank starts buying this stuff, because this is going to be the paper that the bank's buying.
Right.
And as that happens, I think, there's probably the odd percent here and there of our REIT exposure that we don't want. And when there's an opportunity to sell it, we'll be doing that.
Yeah, that's an interesting point. Like, listen, if the central banks are going to come in and create effectively agency paper and be buying principally, I think they're going to stick to the short end of the curve and not be caught, very long in duration. They're there to provide liquidity, not to make speculative investments. So we'll see steepening of curve and all of that. So we've got about, a minute left. I wish we could have had some more time, but maybe walk me through really quickly what the positioning opportunity is, and I'll thank you in advance if we run out of time.
No worries. Yeah, so today we're, the impact on the short end of the credit curve has been significant. So that's what's caused, a lot of the credit spread widening, because credit curves have flattened because of the liquidity drain. Those curves are normalizing. Like, most of the money that was returned to our fund, we made sort of 8.5% in April. And a lot of that came from the fact that the curves, front end of the curve really sort of rallied more than the back end of the curve did. So we're going to collect those, that rallying, narrowing credit spreads over the next, I would say, 2 to 3 months. And as this issuance continues in the longer end of the curve, I expect to see that continued steepening. And so we'll be looking to kind of de-lever the portfolio a little bit, move our exposure out the end of the out the curve to where sort of term spreads are elevated, and really have our cake and eat it too. So take that capital gain out of the short end, and then I believe over the next 12 to 18 months, as issuance reduces, that we'll get that capital gain out of the longer end of the curve too.
Awesome.
So
Mike, thank you. I'm going to get cut off in about 10 seconds. So sorry for that. Thank you so much, and I look forward to chatting with you soon.
Awesome.
Cheers.